Good afternoon, ladies and gentlemen. Thank you for coming down to CLI's pre-AGM briefing. My name is Benjamin Goh, Head of Research at SIAS. With me is Chee, Group CEO, as well as Paul, Group CFO. So on behalf of SIAS as well as retail investors, I'd like to thank CLI for giving us the opportunity to, get a free lunch and also to ask questions of the management. All right, I see some familiar faces. Some of you could have gone for this week's or attended this week's ESR read as well. As you can see, the food is better. A couple of admin points. One is that CLI's AGM is happening on the 29th of April. That will be this month, 10 a.m. at Marina Bay Sands Expo as well as Convention Center at level 3, the Hibiscus Room, Hibiscus Ballroom. So since all of you are already shareholders, obviously whatever that's going to be discussed today is public information. There's unlikely to be any kind of new information that's going to be coming out if it's not already announced, and therefore any kind of new information, especially if you've got first quarter results or whatever, will be announced at the AGM. So do attend that if you are interested. Okay, the other admin point is that we want to keep this a little bit casual. So if you have got questions, just raise your hand and somebody will come to you to give you your mic. Do they have to announce their name as well? Yes, please announce your name, right? And then you can ask a question. We would like to keep the tone a bit, friendly, right? So we're all among friends here. I mean, we did feed you, right? Give you a coffee. But it also is an opportunity for, CIAS as well as the management to kind of gauge or, kind of understand the kind of concerns that you have before the AGM. So that will be very helpful for us as well. Okay. So without much further ado, going to pass the time over to Paul, who's going to run through the highlights, financial highlights, and then after that, we're going to get going with the Q&A.
Thanks, Ben. And good afternoon, everyone. Thanks for coming by. It's nice to see actually quite a number of familiar faces. The truth is, this is actually one of my favorite events during the year. It gives us a chance to engage more directly and really find out what is going on the ground in certain areas. So I'm just going to start and share some highlights, and then please save all your hard questions for Chee Koon. He'll take them after this. So very briefly, because I think most of you would have seen our full year results, I'm just going to share a little bit about just 5-6 slides about what happened for us last year. So those of you who may be a little bit less familiar with us, this is our business model. What you see on top is our fee income businesses. And this is the part of the business that we're really trying to grow. This is, as most of you will know, our listed funds business, which is really the REITs, so the management fees we earn from the REITs. Our private funds business, which is very similar, except for largely private institutional investors. Our lodging management business, which you would recognize from the brands Ascot, Citadines, Oakwood. So we manage almost 1,000 properties now, and we earn a management fee from managing those assets. And then the last one on the left is our commercial management. And this is our property management business. For all the CapitaLand malls or buildings that you see, this is the property management team. So we earn fees from these 4 businesses, and this is the part of the business that we're trying to grow in order to become a little bit more asset light and get that strong recurring fee income stream. At the bottom of the slide, you see what is in many ways much more of our legacy business. Before our restructuring, we have 2 parts. We have the investment properties that we own. So we still own about 4 billion worth of properties in different parts of the world. So this has come down. We used to, 3 years ago, we had about 11 billion. So now we're down to about 4 billion. And this is the income that we get from here is really rental income from these buildings. And then the other component that you see is our sponsor stakes in the listed funds and private funds. So this is our stakes in the listed REITs. So as you know, most of our listed REITs, whether it's CapitaLand Integrated Commercial Trust, CapitaLand Ascendus REIT, or Ascot Trust. So we now have 7 REITs, and in these REITs, we own stakes generally between 15 to 25%. So we include that income under that component. So this really makes up how our business looks now. So what were we focused on last year? Last year, there was a few main things that we wanted to get done. One was really the divestments. The idea of becoming a bit more of an asset-light business, not having as many properties on balance sheet and really getting higher value fee income streams. So last year, we divested a little over 5 billion worth of assets. Many of you would have known, I think it was in the papers, we sold Ion Orchard, We also sold a handful of US multifamily assets, US rental housing that we had on balance sheet, and we also sold some lodging properties. And that helped streamline our balance sheet quite a fair bit, giving us now, I think, especially in the current turmoil in the market, a much stronger balance sheet and position to grow from. The second thing we did was we really focused now on where we are deploying. And there are a few themes that we're really focused on, which I'll show a little bit more on one of those slides, but it's really around the living and lodging sector. So about really on rental housing, senior living, student housing, service residences. We believe this whole living theme will continue to grow. We focus deployment on logistics and self-storage. We think that's also a trend that will continue in that area. And then we focused on private credit. And these were some of the areas that we really pushed some of our investments behind. And then the last thing was really about how we shape our balance sheet. And that meant partly doing some share buybacks and also the 18-cent dividend that we are proposing, which will come to AGM in 2 weeks or in a week. So last year for us, we grew quite a fair bit from a funds under management. So we are trying to grow this part of the business, as most of you would know, to all the way on the right, the 200 billion target. We get a lot of questions on how are we going to grow that much and how are we going to get to 200 billion. For that question, I will leave that to Chee Koon to answer because that's a tougher one. But what we did do last year was our 99 billion, which was where we were at the start. We managed organic growth of about 5 billion, which in the current market is actually pretty, we thought pretty credible. Private real estate last year actually had one of its hardest years globally, the hardest fundraising year pretty much since GFC. In a sense that people have been a lot more cautious and have been less likely to invest in big ticket or long-term items, which makes it much harder for us to raise the money you need to buy a building such as this one. But we still managed to raise quite a fair bit, and so we grew 5 billion. And then we did 2 overseas M&A, mergers and acquisitions. We acquired SC Capital. Some of you may know SC Capital. They are the owner of Japan Hotel REIT, which is the second largest hospitality REIT in Japan. So of the 11 billion that we invested into them, 8 billion of that was really relating to Japan hospitality assets, which is an area where we think there will be growth, both in terms of the hospitality side, which is one of the themes that we believe in, but also in particular Japan, where I have realized in particular Singaporeans, Hong Kongers, Koreans all like to visit. And we think that growth in tourism for Japan will continue. So it was an area of focused growth for us. And then the other platform, the Wingate, which is the 2 billion platform that you see there, was for Australian private credit. You'll probably have seen in the papers a lot of growth or interest in private credit. So we are focused on real estate credit, which means that besides in just investing in a building, we'll also lend money to people to build a building. So it generates a pretty good return in the current market. So our Australia fund targets between a 12 to 14% return on IRR, or return on investment for investors. And we think this is an area that will grow. It's an area historically we haven't done as much. And so one of the reasons of acquiring a platform there was to help us build the capabilities so that we can do this business. So maybe just 2 things to highlight on this slide. This is just a little bit on our financial performance. Some of you have seen it. So last year, our operating profits were 510 million. This was down from the year before. Environment was a little bit trickier last year than the year before, and continues to be. But I think what we thought was important on our operating PATMI is if you look at the chart on the right, what you can see on top is the amount of income we get from our fee business. And the component below is the amount we get from our real estate investment business. One of the reasons we're trying to shift in this direction, and you can see since we restructured, we've gone from 40% to 62% in the fee business, is because we're trying to make sure, and I think with this one we are aligned with all of you on, we're trying to get our share price up. And for our share price to grow, there are a number of components, but generally a lot of analysts look at us for the fee business, they look at us on a multiple basis. So they would value at us between 12 times to 18 times on our fee business, as compared to the real estate investment business, where they just value us according to book value. So it's whatever is the value of our assets is generally how they would value us. So we do think from a share price perspective, growing the top bucket makes it a lot more valuable for us, which is why we're making a big push to grow that component. So we are making progress there. I think we have a fair bit more hard work left in front of us to do, which is really growing the absolute profits, which I think would benefit all of us if we can get that to continue to expand. So just two last slides. This is, as I mentioned, wanted to share a little bit on what are some of the general themes that we believe shape where we like to invest. On the left-hand side on this slide, you can see three areas that we're focused on. We're focused on changing demographics, which is one of the reasons we pursue areas such as the living sector or self-storage, because we think demographics are moving in that direction where there'll be benefits. We are focused on disruptions in different areas, disruptions including how people approach real estate. So we include private credit in that bucket of disruption on how people are funding real estate growth. We include areas, digital infrastructure, renewables, data centers, which I'm sure you're all familiar with. And I mean, under digitalization, we include that component, which you're all familiar with. So we're really looking at these three buckets. And the idea is that we think they're long-term trends. So even though the market is going up and down right now, some of the things that we're investing behind, particularly as real estate investors, when we invest, they're usually we look at it on 5 to 10 year timeframes. So we want to make sure that the market trends are behind us. So we're really focused on those three areas. In the middle, you can just kind of see our distribution by geography. We're still very much Asia focused, though we are trying to grow a little bit more in markets such as Japan, Australia, through the acquisitions, and we're trying to expand that and potentially go slightly further. Part of that is to manage our risks. We're worried about being overly concentrated in certain markets, particularly given all the geopolitical turmoil in the world. We do think having a little bit more diversification will make us a stronger platform. And then this is sort of the last slide and really where we're focused on for this year. So I talked a little bit about where we are focused on or what we accomplished for 24. For 2025, it's really these three areas for us. Given that we've got the strong balance sheet after all the divestments, we are looking to make sure that we invest and we're able to grow. But we start really with people first. We want to make sure we have the right team, the right management, the right investment professionals looking at where we deploy our funds. We're looking at new platforms similar to the M&A that we did and new product types that fit some of these trends that we're seeing. And then, as you can see in the middle, we are looking at more potential M&A. If there are good platforms, especially in the market, if we can find, as with all of us, if we can find good bargain deals, assets at distressed prices, this is something we want to invest behind. And then the last thing we are doing, and that partly ties to our dividend, is we're trying to make sure that we're the right size company, which means in certain cases, it means buying back our shares. In certain cases, it means giving out more dividends or distributions to make sure that we're the right size. But we're also working at the same time on cost rationalization. Knowing that it's a tough market, we want to make sure that we are also being careful on where the company spends its money, how we are using our team, and making sure that we're as efficient as we can be. So that's really our three main buckets. And maybe let me stop there and pass it to Chee Koon to see if he wants to add anything.
Thanks, Paul. I think Paul gave a pretty good overview. I think that at the top of the mind for many people, it's the headlines that we are all reading. What's happening out, US, China, tariff, reciprocal tariff, and all the concerns and what it means for many companies. Pardon me for using some of the words of some of our politicians. What the US is doing is really changing the regime that we are all used to, and how things will change and how things will land. To be honest, nobody can see quite clearly how things will be. I spend a lot of time on the road talking to politicians, investors, partners. There's a general sense of caution, and country level, people are recalculating their moves. And I suppose there will be a period of uncertainty. And when there are periods of uncertainty, generally, you will see companies, especially for companies that do major capital investments cross-border, especially for companies that need to do exports to major markets, they need to rethink and reprioritize because they need to be clear. Big capital investments, when you decide to build a factory in, say, a particular country, it could cost easily 40 million, 200 million. And the question is, do you do now or do you wait for things to be clearer? So that's a big thing that is happening around the world today. So we need to see how things will evolve, and hopefully things will become clearer in terms of where things will land. But under such a situation, to me, it should present interesting opportunities. I said that we cannot think of opportunities in the same way, because it's not like a typical recession where there's oversupply or there's a financial crisis. That there are policy levers that you can do. Oversupply, you just drive the demand, or you stop the supply, run through the cycles, things will improve over time. Or there's a financial crisis, you can print money, you can capitalize the banks, and then things will go down, then they will go up. What we are seeing here is a reshifting of the economic and the political landscape in a new way that at this point in time, I think nobody can tell. So it's a shift, but they should throw out interesting opportunities. We are thankful. I mean, not that we could foresee that such a situation would emerge, but because we have been so disciplined in recycling and making sure that we keep that balance sheet, it gives us interesting ammunition to be able to capture some of the mispriced opportunities. Of course, when we look at deals today, our priority is we want to look at things that can offer us much higher returns, special situations, people in difficulties in terms of financing. It becomes interesting, or focus on opportunities that give us very good clarity in terms of cash flow. We like the private credit type of deals, especially in the real estate side, because we do understand the real estate. We hope to build a much bigger private credit business. And we, of course, want to get people to pay us back. But because we understand real estate, in the event that there is a default, we believe that we can better manage. Even if we have to take over the real estate, we can handle it better than most other people who are just normal private credit players. So these are the few key things that we will focus on. Other strategies, things that we believe in, will be the lodging sector, the living sector. No matter how the world change, no matter what kind of technological disruption, you still need a place to stay. When you travel for business or for leisure, you still need a service apartment or a hotel, which is why we make a very deliberate move to take a stake or partnership with SC Capital. They have a very, very strong presence in Japan. Together with their hotel presence and their capabilities in terms of asset managing them, plus our service apartment and our rental apartments. Actually, today, we are close to 20 billion of asset under management in this lodging sector. We have the data. We know why people travel, how people are traveling, how long they stay. And it gives us a lot more confidence to be able to make investments and be clear how we can drive those numbers. And those are the major priorities that we will be focusing on in terms of growth. Of course, there's another market that we are spending a lot of time on, which is on India. Ever since, India, for some of you who may be long-term CapitaLand investors, India was never a big part of CapitaLand's business until the merger with Ascendas-Singbridge. India is a big market, but a very difficult market. But Ascendas-Singbridge, the team, they've been there for 31 years. Being able to get land with clean title, being able to do development, being able to raise funds is something that the team has built up very strong capability. Last week I was in India, had a chance to meet with the biggest banks, and these are from the CEOs from the banks. They said that we are the only player in India that has such a big presence across the major cities in very interesting asset classes. And whatever that we have built, whatever that we're committed to build, we completed them, and there has never been ever a default before. So our credit rating, our reputation in India is tremendous. and the market is big, it's 1.5 billion people, and our team in India is all led by our India team. So I think there's a lot of legs for us to continue to do. And for a very interesting reason, and maybe I hope I'm not speaking too soon, India seems relatively protected in this current world of geopolitics. Must say that the political leadership, managed to handle this quite well. And I say I'm thankful that we have this team, and important that we continue to take advantage of our team to build a much bigger business. The land that we own, it's all clean, title, and just imagine the possibilities that, as a city expands, because they are either business parks or logistics or data centers, they can always be converted into other uses. So that's an important area that we will be focusing on as well. So thought just leave the few comments for you, then we can have more Q&A. Thank you.
So thank you very much, Chee Koon. Thank you very much, Paul, for giving us the broad overview and strategy of CLI. So we're going to open up the session to Q&A, and as the moderator, I will have first dibs on the first question. Right. So either to Chee Koon or to Paul. So you touched on the current volatility in the market. You touched on PowerPoint, the transition from a asset-heavy investment perspective to a more income-based operating model, and also you had a slide about your geographical footprint. So the question is, so given what's been happening, the tariff war, so on and so forth, tariffs are on, tariffs are off. I don't know when I'm going to lose money tonight. I'm going to make money. By the way, I lost money last night because Nvidia went down again. You never know, it's like throwing dice, right? So how does all these, volatility as well as tariff war impact the strategies that you have? Is that going to change your idea about moving from an asset, to an asset-light business model? And is that going to change your portfolio allocation to Japan or Korea, so on and so forth?
So maybe two parts, if I can answer on that. One is, I think the first thing we did was we looked at all of the things going on in the world, particularly with the tariffs, and looked at how does that impact us as a portfolio. I think in this instance, we are rather fortunate in the sense that a lot of, I would say, the first order effects don't hit us as much. Obviously, we're not an exporter, so we don't get the tariffs directly. We're not consumer products. So what we realized where we may potentially get the most impact is one is obviously we have a number of logistics facilities. Those slightly less than 5% of the funds we manage, funds under management are logistics. We did run through all of the portfolio to see, how many of our logistics tenants are exporters to the US. How many of them may get affected by this? How many of our logistics facilities, where are they located? Are they near airports? Do they focus more on domestic? And I would say when we looked at the overall, we realized that for the logistics portfolio, we think probably less than 20% of our logistics portfolio will get affected on a first order. That means directly. The other part of the business that we thought will feel it a little bit more is on the lodging side. As people stop traveling between countries, particularly to the US, where we've already seen a drop in people traveling to the US, we think there'll be a little bit more direct impact. I think fortunately for us, when we look at the holistically, that probably will impact directly less than 5% of our income. Our bigger worry is second order effect. If things get worse in the environment and the market, and potentially we see a recession in the US or even here in Singapore, then we will start to feel a little bit more. And I think all businesses at that juncture will feel it. So we won't be immune to the second order. But I think on sort of the first part, we're at least a little bit protected. So I think when we look at our business model, this shift from being a bit more asset heavy to being more asset light, I think the good thing is our asset light income is actually very resilient. The fees that we get from managing commercial properties, managing the REITs, is very stable income. The only impact that we know we will feel is there'll be lower transaction volume. There'll be less deals in the market. And usually we earn some fees from either buying or selling of assets. And that part will become very quiet, we think, over the next few months, because there'll be less transactions where everybody is on a wait and see. So I think for us, when we look at the business model, we're fortunate that that we've got a portfolio that is going to be very resilient, and we've got two income streams, the fee side of the business and even the properties we have where we expect the income will be resilient. I think the challenge for us going forward and where we're really trying to focus on is how to still grow our fee income in this environment. And that part is a little bit more challenging. And I'm sure Chee Koon has the answer to that, so I shan't say any more.
We deliberately make a move from a developer to an asset manager because we spent a long time thinking about that. Our view is that to build a resilient business where you're building fee income is actually it's a more resilient business model. It's one where you can not just do a business in Singapore, but in the various markets. Because as a developer, to be very, very honest, I think we did well as a developer from Singapore, and we went to China. And the reason why we could play in China at that point in time was because many of the Chinese developers, when the markets first opened up, there was not a lot of people with a lot of development experience. And the second most important thing is that there was not a lot of capital available. So at one point in time, some of you may not know, CapitaLand was amongst the top 10 developers in China. But then, when the capital market started opening up, there was no turning back. The Chinese developers became so big. They could do things that we could not do. They could build much faster, and not just faster, cheaper, and sell things not lower than what we could sell. So it's very hard to compete in those manner. But if you're an asset manager, what you do, it's very different. It's about the quality of the people that you have. If you can build strong talents, people who network very well in the different markets, find good deals, convert any opportunities into higher returns. And if you can find good projects, mispriced projects, deliver the good returns, it's not difficult to raise money. If I can deliver, say, I tell people I can deliver 10% for you, and I deliver it, it's much easier to raise money the second round because there's trust and people just feel comfortable because they know that you can deliver. But if you do development projects, you buy a big piece of land and you take 5-10 years to go and develop. Along the way, there could be recession, there could be tariff, and there could be, all this tariff will lead to increase in import of materials, or, you could have problems in terms of immigration, people moving easy for you to get cheap labor, your construction costs can go haywire. It's very difficult to underwrite those numbers fairly, to be able to fairly determine the returns for investors, which is why, we changed the business model and say we want to focus on fee income. And the important thing for us to do is to grow the fee income so that, it becomes a big part of the business. And the more you can raise third-party money, the less capital that we need as a company. And it gives us a lot of optionality to do things. This capital we can use to build new capabilities, we can use to seed new ideas. We could even do more capital reduction, like how we do the distribution of units in our REITs. So that's how we are thinking about the business at this point in time. So if you ask me, given the major challenges that's happening around the world, is that going to affect the model? I think so. It may affect the ability to fundraise because everybody is afraid. Then a lot depends on, can you find good deals? If you can find good deals that deliver good returns and we are prepared to co-invest with them, I think people will still invest, because I don't believe that in a market, if you can tell people that you can deliver, say, 20%, we are prepared to co-invest, and everybody is just happy putting money in the bank. I really doubt so. Yeah. So key is whether you're good people, whether you can find good deals, or deals that can produce very, very strong cash flow and returns. Yeah.
Well, thank you for that. And I really like how you articulated the strategy, and also I really like how Paul segmented the first order and second order effects. So the point I guess we want to remember is that the current market volatility and the economic situation impacts everybody. So it's not a CLI specific issue, right? You got other companies like Apple or Nvidia that will have it much worse. All right. So that's something to remember. Okay. Yeah, so I'll sell Nvidia tonight and buy CLI tomorrow. Yeah, I like the diversification. Okay, so we're going to open up the question to the floor. So my colleague is coming with a mic, so there are two gentlemen here.
Hi, my name is Vincent Tan. I read this morning that we are going to do a series with CLCT. So I think Chee Koon mentioned that we things might slow down and all that, right? So I really would like Chee Koon to give us some idea about on ground the market in China, and whether the fact that the China for China strategy is still resilient in this environment, and maybe to try to understand whether the series market, right, is thriving, because for a certain part it wasn't really doing very well. The yields were like close to 10%. I'm not sure the price book. I couldn't get it online. But maybe you could like tell us about this, and whether which stage are we at that part of the journey, and because also the other part of the thing is that for the fee related income, right, we were reducing the exposure to China to try to grow fee related and recycle it elsewhere, right? So with the recent stock market rise and all that, right, in Hong Kong exchange and all that, there appears to be more southbound. Their safe assets, SAFE. The China has some safe assets, money that they seem to be pumping money down to the Hong Kong exchange, which is supporting it. That's in my opinion. So my sense, I would like you to comment also whether is it looking like that's, although the two systems are bifurcating, the two ecosystems are bifurcating, whether there is a need for China, US, I mean, kind of like other outside China for US or something like that. And how are you thinking about the fact that you are allocating your funds and your strategy? Thank you.
Okay, there are a number of questions. Broadly, the Chinese economy, in my view, I think has reached its bottom towards the end of last year. We started to see Chinese government taking a more concerted effort to make sure that the economy strengthens. I think few strong indicators. One, the Chinese people also feel a lot more confident. NERZA was launched very successfully, very well accepted, showing the soft power. And not too long ago, there was a DeepSeek, the Chinese developed AI machine capability that I would say surprised the AI world, where it was, not sure whether you followed in the US type of AI engine. It's closed. It's a closed system, whereas the DeepSeek is an open system, and they could do it in a much lower cost to be able to allow people to use the AI. So I think things are changing. You are not wrong to say that the Chinese economy was undergoing through challenges, especially after COVID. But I think long-term wise, if you look at the capability of the Chinese economy, okay, I want to say I cannot quite read what's going to happen between the US, China, how things will land. But as a country, in terms of capabilities as a whole, the Chinese has demonstrated that across many of the things that they do, whether it's low-end manufacturing to high-end technological capabilities, they have actually done very well. there's actually an Australian strategic policy institute that came up with a study. They did a study for across 2 decades about the major capabilities of big powers, China, India, US. So in 2003, this is from an independent Australian researcher. In the year 2003, out of the 64 leading technological sectors, at that point in time, US was leading. Leading means number 1 position in about 60. And when they did the study last year, 60 out of 64, okay, that was 2003. When they did the study last year, they found that China was leading in 57 sectors and the US in 7. So you could see the Chinese economy strengthening in across everything. I mean, in the past, China only focuses, you only remember China as you buy clothes, you buy slippers, you buy the cheapest things from there. But today, in terms of EV, in terms of major electronics, washing machine, I mean, everything, it's really China, right? So short term, yes, I think that still adjusting, but with some of this stimulus coming through, some of the confidence, actually we are starting to see increased demand, spending, especially on the tech sector side in the early part of the year. Too early to tell what this US-China tension could emerge. At least you see the GDP numbers from China that came out just yesterday. I think the number was I think surprised the market, but I think too early to tell because there are so many moving parts, and I don't want to forecast things that I actually have no clue. But what we saw on the ground was an improve in terms of leasing requests and activity and spending activity, at least in the first quarter. Okay, so that's on the China side. We took the view to focus on building a business on a China for China. Ever since the restructuring in the year 2021, we have raised almost 50 billion renminbi from the Chinese insurance players. That's about almost 10 billion Sing, depending on exchange rates. And there's still a big pool of domestic capital available. What's happening today is many of the major insurance companies continue to sell life insurance. When the economy was very strong and interest rates were much higher, there was a certain minimum returns that the insurance companies will promise the insurance buyers. But that has since come down, maybe 3% or so, or 2.5%. 10-year today, based on what we see in the market, 10-year treasury bond in China is about 1.6, 1.7%. So as the insurance companies, you sell the insurance premium, you have all these liabilities. Where do you put your liabilities to? Where do you find assets to match all these liabilities? So I can assure you that there's deep pools of capital available in China to be able to acquire things. Of course, because there are more sellers than buyers, and the buyers naturally tend to be a bit more demanding in terms of pricing, in terms of terms. It's just that we also want to make sure that, are we desperate? If you're not desperate, then why do you want to go and rush to do certain things? But of course, all this we will prioritize. We look at the world. We'll ask ourselves, whether it's better to aggressively recycle. We may leave a bit more money on the table, but in exchange for that, to get the capital so that we get ourselves more ready to buy mispriced assets at this point in time. On C-REITs, we announced the launch of the C-REIT this morning, or rather the application to want to launch the C-REIT. There's going to be a process where eventually the authorities will give us a price range before you decide whether we are comfortable with the pricing, and you can choose not to do it if you're not comfortable with the pricing. So that's where we are in terms of the C-REITs. I believe I've shared earlier before in some of the forums to say that C-REIT is something that we were looking at. It's just that, just to apply to get a C-REIT takes time. We have to apply through the various authorities from the NDRC and then to the CSRC. Took a while. And that's why it took so long before we could even register the application. And the announcement came out this morning. Yeah.
So the timing of the announcement today, is it a signal that there's confidence in this China for China market? And then
Yeah. I mean, China for China is something that we have announced, something that we believe that that will be our strategy. There are deep pools of capital in China. C-REITs could be one. You will see us potentially having more partnerships with more domestic capital. We hope to be able to announce some of these initiatives soon. I can, at least based on what our business plans are and based on all the interactions, I think, we are quite, I don't see any problems in terms of tapping domestic capital in China at this point in time. Yeah. You asked another question about, just to finish up the question that you asked earlier, about all these global conflicts, whether it affects capital flows. One of the things that we have done is we have been very focused on trying to tap on domestic capital in the various markets as well, in the way how we operate. Like in Japan, we tap on Japanese capital for our Japan business. We are tapping on Korean capital for our Korea business. We are also tapping Australian capital for our Australia business. Because we want to make sure that as we build our asset management business, apart from tapping on institutional capital that can invest globally, but we also want to tap on domestic pools of capital. It could be insurance money, it could be family office capital to help us, because everybody is looking for investment opportunities. So that's how we are building up our business, but slowly, and it takes time. You want to make sure that you find the right deals, deliver the good return. Some things you cannot rush. Yeah, it's building your reputation, building your track record.
Hi, Manu here. Hi. Yeah, thanks for this session. I kind of like what Paul presented. About the, you are spreading in terms of your fee incomes to greater geographic regions like India and so on. And it showed that China side you're going to reduce. But the thought is that overall, I think it's a good strategy. And then also, especially if you do C for C, country in country kind of funding, because cross-border may reduce, I think, with this current protectionist mood. The protectionist mood, for example, the flow from US to PRC definitely is going to reduce in terms of investments. So, if you plan, you had a good plan on China earlier, but now that sort of flow from Europe to US and Europe to China is going to shrivel for sure, right? But on the other hand, as Chee Koon said, China economy bottoming out. So I'm in two minds on this. I think China is recovering, actually will recover, will be very strong. And in that case, so should you continue to at least see within China, the deep pools of funds that you spoke about, to continue to grow that business, So maybe what you have allocated, 20% for China, seems a bit low, I think. I don't know. Longer term, sometimes it's good to be contrarian. So if you think you are on a low end, why not focus on it now, right? Because when it grows, then you are there. That's one thought, but you might want to comment on that. The other area is, I think India's focus is also good. I know it's a tough market. It's different. It's democratic. It's, sometimes land titles are very foggy. Who actually owns it? Somebody might come and claim and say, actually, this land belonged to me 30 years ago. So, but on the other hand, it has a democratic court system, all that, and you have a deep pool, like you say, your Clint, your CapitaLand India Trust, I have invested in a long time ago. It does quite well. I think they're doing quite well. And they're really at the top of it, what's going on. So it's good to stay there as well. And it's true that India is relatively cushioned from this tug of war, between the two superpowers. So you are in the middle over there, and big market as well. Now the other question is, of course, today's announcement, the C-REIT. I think it's good for CLCT, for the China Trust, because they are gearing a bit on the high side given impairments and all. But the question was, of course, in the announcement so far, that info is not there. Like, so did they have putting in these assets? They must have already valued them. Did they have to take a haircut to both CLI and all to make it, or is it? Of course, it's revalued every year. So is it already okay value? And you are just waiting for the authorities to. But it's a good idea, and I think it really relieves the balance sheet somewhat for CLCT, and probably for CLI as well. It's a good thing if you can do that, and maybe later on increase the size. So right now, 2 seeded assets. So you might later on you will have more assets. So maybe you want to comment on these things. Yeah, thanks a lot.
Thanks, Manu. I know the first Vincent, Manu, and I know the third question is coming. That's why I have my notebook, because I realize I always have to take notes when you guys ask questions. So on the allocation to China, yes, on the chart that we showed, it shows it going down to 15 to 20%. But because it's a 100% chart, it's a smaller proportion, but the absolute size we expect it to grow. So we're going to grow from 100 billion to 200 billion, so up to 117. So China, while the proportion comes down, we're still growing it on an absolute basis. So we're still long-term believers in the China market, and we're still trying to grow it. So it should still increase. It's just that we're putting more focus in some of the countries where we're not as strong, like India, to try and accelerate those so that they grow faster. So just a little bit of a change in allocation, but still focus on growth. On the C-REIT listing, it's funny, and Vincent asked why did we list it today. It's because we knew you guys were coming, so we put the announcement out. No, actually, we had to put the announcement out because it was being approved by the regulator today. So they were going to put it on their website. So since it was on their website today, we had no choice. We had to make the announcement today. Subsequently, as the status changes on their website, and then we would make subsequent announcements. So we're really dependent on their timing. We actually just think it's quite fortuitous to us that it was today so that we could talk about it, and we can talk about it during the AGM. So I think that was good luck for us. Hopefully the year is that way. So on the pricing on the C-REIT side, so we can't comment for CLCT. We'll leave that to Jerry, their CEO, and the team to comment on. But I guess what we would say is, the pricing has yet to be determined. So obviously we have a price range, but the pricing hasn't been set. And because all of us, ourselves, CapitaLand Development, who's also our partner on this, the private side, and CapitaLand China Trust, because we do annual valuations, we wouldn't expect significant movements from the annual valuations.
Yeah, I forgot to answer your earlier question. What the REIT is trading is about 4-5% in terms of yield. Or there was a period where it corrected to about 7%, but it's about 4-5% now. Yeah. Sorry? Some trades, depending on the asset class, some trades above, some trades at about. Yeah, there were a small handful that don't trade as well, but generally okay. Because it's a very regulated. The regulators, I mean, if we think that our local regulators are difficult, well, it's a different ballgame when to get approval in China.
So the gearing ratio, if I'm not wrong, is 28%.
Yeah,
I'm surprised that we got traction there.
Yeah.
I'm very happy that we got traction.
Yeah. So because you see, whenever we talk to our Chinese regulators, they say that their population is 1.4 billion. So whatever they want to do, especially if they want to assess retail capital, they want to be very, very safe and do it very properly. I mean, this is the same thing that we do as well, because we're talking about the retail investors. I mean, it's the savings and dividend income for retirees, and that's why it's very important that whatever we do, the products, the curation, and how we invest properly becomes critical. And you see, the regulators will come after us if we don't do things properly. And for us, reputation is everything. Yeah. So the general rule is this: if you, at least based on today's rules, the rules in China keeps improving. Okay, it doesn't get worse; it just keeps improving. So it started off a lot. It's very, very stifling. That's why we didn't even apply for it, because it just didn't make any sense. Along the way, they lightened the requirements for reinvestments, and some of those issues. So we decided to apply for it, and we think that you'll continue to improve as they see more and more quality issuances. Yeah. So I mean, the market is big and is very, very deep. Yeah.
Okay, thank you very much for that. There was a question there.
Yes, thank you. Gerard Ahot, a shareholder. So thank you for the session today. So I have a question on what you mentioned, the right sizing of the balance sheet for the company. So just if I refer to the investor day that you had end of last year, so I'm trying to put some numbers on that. You mentioned some targets by 2028 in terms of operating PATMI of something like 1 billion. So that means that would represent around 20 cents per share. And in terms of NAV, where we are now, it's around $2.7, if I'm correct, the big numbers. And so you mentioned that your target in terms of ROE would be to reach double digits, so let's say 10%. So just my question is, let's say by 2028, if we were to reach 10% of ROE, 20 cents of potential EPS, that means that we would have to shrink our NAV from $2.7 to $2. So that means a lot of actions, buybacks, special dividends beyond the normal dividends of 10, 12 cents. So that would represent 70 cents, something like that. So I'm just wanted to check if this is a fair reasoning or if there is something wrong with my numbers, just to have the global picture of where we want to go, in terms of balance sheet.
Would you like to join my finance team, please? I could use the help. It's a very good question. Exactly. So we are trying to get to more than $1 billion. Ideally, it is more than $1 billion. $1 billion was what we had put out at Investor Day, but we'd love to grow beyond that. So if you look at us on an operating earnings basis, the last few years, we've generally been about 500-600 million. And we have obviously had some fair value movements, large from our properties up and down the last few years. So I would say we are generally typically anything between sort of 300 to 900, if you include the fair value movements. But just say our operating profit is about 600, right? That's where we've been the last couple of years, 500-600. So if you look at our distributions, we're distributing this year about $600 worth in dividends, and we're distributing an additional 300 million worth of CICT units, or we're proposing to do that during the AGM. So if you put that together, and on top of that, we did share buybacks of about 300 million last year, 350 million. So actually we grew by about 600 million, and we shrank are giving out, because we haven't distributed the dividends yet, we will go down by about 1 to 1.2 billion. So that you're exactly right, that will shrink our NAV per unit. So there are two things to it. One is we think that's possible because, as Chee Koon mentioned, we don't need the money for buying properties anymore. We don't need as much because we're able to raise third-party money. So we can grow the business without using so much of our own capital. So when we look at best use of proceeds, we will use some of it to reinvest into growing the business, but some of it we are looking to return to shareholders. So that's why we think the numbers can work. When we look at our share price, which is obviously one of our major concerns, we used to be valued very much as a price to NAV type play, which if you look at any real estate company, and if you ask any Singaporean, everybody knows for property companies, or REITs, you buy it at NAV. But for most fund managers, when you look at them globally, Blackstone, Brookfield, or even in the region, GPT, Charter Hall, Goodman Group, they all trade on a multiple on the earnings. So we think over time our stock changes to be a multiple of the $1 billion we earn, rather than being looked at as a NAV value. So you're right, that balance will change, but we still believe with that the share price should still move up.
Okay, thank you. And just another question, and a small one. So you mentioned during the post-earnings conference call with the analyst that last year we managed to get some big new customers, institutional customers. You mentioned a number of 19 LPs, if I'm correct. So maybe you touch on that with the Chinese insurance companies, but just as an illustration, just to understand what are these new guys and for what kind of products. I guess maybe more for the private funds, but just to have an illustration of the commercial aspect. Yeah.
Yeah, so this is in our full year results slides. We show that for our private funds, we added 19 new private investors. So we had a number of investors, of our private investors who re-upped with us or reinvested with us, but we added 19 new investors. So this is for the private funds that we run. So for instance, we have a Southeast Asia Logistics Fund, or we have a India Logistics Fund. So these are private LPs who, some of these would have been new insurance money. They would have been Japanese corporates who are very interested in investing in India. We had LPs from Thailand and other markets investing into some of our Southeast Asia products. We had Chinese sovereign wealth, not Chinese sovereign wealth. We had Chinese investors investing in our Australia credit fund. So these are some of the institutional LPs we added last year.
Okay, thank you.
And a number of family offices as well. Yeah, some of the family offices can write pretty big checks. Yeah.
Okay, great. Thank you.
Okay, thank you very much. There was a question somewhere in the middle. Yes.
Okay. CapitaLand Investment has started, I think IPO'd in 2021. So we have about 4 years plus around now. In the big picture, I would like to understand a little bit, how so far how we are, when we launched, when we IPO'd. I think investors like the idea of the transformation. So it was pretty big bang of the listing. So I would like to understand in the big picture wise and how much you have achieved versus our vision at that time, and maybe if we have changed some of the strategy or goalpost along the way, and because we are in a changing world, so there is good reasons for doing that as well. One of the things I would like to say is that I noticed we have a couple of companies, even local company. They have done quite good job about like a 5-year vision, sort of renew or refresh. The market actually, the example of ST Engineering, for example, and it used to be a very defensive company. And the vision they have projected back 4 or 5 years, they have achieved to a certain extent. That's what the market have given them really good credit. That's right. So this is one way I would see that CapitaLand Investment actually, because this is also, there is a lot of new elements of the business. You talk about private fund, how to mix all this, and you talk about private credit, what you're trying to do, and there's a lot of new things, right? So I guess investors need some more education and also need more clarity, because we are a quite long-term investors, right? So the vision and also and the rationale of how you project that would be very important. Thanks.
So maybe I'll answer the question in 2 parts. When the reason why we did the restructuring in 2021 in the depths of COVID, I took over the company in 2018, towards the end of 2018. At that point in time, we did a review with the board and the management. CapitaLand in the history, since we were listed from the year 2000, we trade at about average of about 30% discount to book value. And generally, investors do not like the lumpy earnings of development profits. And we make a very concerted decision that we want to move the business model to one where we are asset lighter, become an asset manager. So during COVID, when the share price was quite low, we managed to convince the investors, of course with the support of Temasek, to help us to privatize the development business and just focus on the asset management. At a point in time, it was a modest aim. We said that we'll hit 100 billion of AUM by 2024. That was the initial, because to be honest, the listed REITs, I think we are okay. The hospitality management, the team is quite stable and they are executing and they are growing. The part that we are really growing is the private funds business. Personally, I mean, the team as well, we think that as long as you build your capabilities, the ability to scale up this business is tremendous. The difficulty that we see, that we experienced in 2021 when we did the restructuring, at that point in time, the economy was still very strong, interest rates were low, and actually China was still humming and doing very, very well. In fact, it was that year that we raised 35 billion renminbi just in from one of the big insurance company from China. And 2022, there was a Ukraine war, and then the interest rate started to move up very aggressively, and then there was a slowdown in the Chinese economy. For asset management company, when you build your track record, you have to. We wanted to leverage on the strengths and the reputation that we have built up in China to create a lot more products, because that's our strength. And we thought that should be able to help us to create a lot more verticals. And obviously, given what's happening in China, that had slowed us down in terms of some of the in terms of the momentum. And we quickly strengthened our capabilities by building our capabilities in other parts of Asia, from India, Southeast Asia, Japan, Australia, and Korea. So that's how we have been doing that. If you ask, and of course, because of a higher for longer interest rates, if you are an investor, typically when you allocate capital, your cost of capital has gone up. So real estate becomes an area where people may not allocate so much capital. That's one. Second thing is the big ask price between real estate for real estate transaction became wider. The people who wants to buy cheaper, the people who own assets don't want to sell cheaper. So there was no transaction. So there was a bit of that slowed down in terms of the fundraising and the growth. But at least based on the conversations that we have, a lot of the low interest rates were locked in about 2020 for 5 years typically. 2025, this is a year where we will see refinancing coming to an end. Low interest rates should creep up quite significantly, and we think that there should be a much more interesting opportunities for deals to be done. So that should give us the ability to really accelerate the fundraising and to do more interesting deals. But longer term, I mean, this is not something that at the back of our mind we're thinking. Because real estate is more cyclical in nature. When the interest rates were to go up, valuation gets affected and fundraising becomes more difficult. So that's why there's an urgency to build up verticals like in the private credit space, which explains why we bought into a platform like Wingate. A private credit business, you will be able to lend money in good times and in bad times, across cycles. And you can raise pools of money. I mean, it's just that in good times, you pay lower margin. In bad times, you pay higher margin. But there's money to be lent, because people want to do deals. They will need to build that part. They will need to borrow, and that's why the private credit business becomes a very important vertical that we need to focus on to build and leverage on our ability to underwrite the real estate and to build that business. We did come out to say that last year to say that we want to hope to achieve 200 billion AUM by 2028. Organically, based on what we are doing from the listed funds, the private funds, we should be able to get us to about 150, 160. We need to do a bit of M&A to bring that up to 200 billion. But although M&A is a much easier path to achieve your AUM, the thing about M&A is buying teams of people. You want to make sure that when you invest in a team of people, let's say you buy a platform, 10 billion. If we invest in a platform that's 10 billion, 5 years later it's 10 billion, we actually don't make real money for the investors. When we invest in a platform of 10 billion, we want it to grow to 20 billion, 30 billion, because you have significant increase in terms of the EBITDA through the fees that we are raising, where we are earning. And that's where you can deliver higher returns. So we are on the lookout for M&A deals, but we do M&A only if it helps to add a certain capability that we do not have today that can help us in terms of fundraising. That's point number one. Point number two is whether it is a team of people that can fit with us culturally. Because if you cannot get along, you cannot work well, you cannot help them to fundraise, it doesn't quite make a difference. And the third thing is whether we are paying a fair price. Last few years, we look at some deals, the multiple that some people were asking for is 20 to 25 times multiple. Meaning that whatever that we pay, we have to wait for, we will only get back the money in 20 or 25 years. That's what it means when you talk about multiples that you pay. So that's why, if you pay for something that's 20 times multiple, you have to make sure that the platform can be growing 4 times. Then we can make sure that we can deliver the earnings. And it's not difficult to achieve headline news. You say M&A, it's not difficult to buy. Right? It's easy to buy. The issue is how do you make sure that the M&A is right? How do you use it to raise new capital? How do you help to deliver earnings to the bottom line? Yeah, so that's how we are looking at it. I'm not sure I answer your questions fully, but at least I share with you the thought processes that we have. Yeah.
Well, thank you for that. In the interest of time, we only have got time for one more question. I think there was a question at the back actually. Yeah.
Hi, my name is Jochen. Question to your India story. So you have CLI and then you have Clint, right? So as an investor, if I want to invest in your India story, should I do that on the CLI level or Clint? How do you kind of work together? And then maybe related to that, you mentioned the land bank that Ascenda's built over 30 years, which is great, but it's also a bit history. So kind of how do you replenish and expand in a market that is kind of going gangbusters, so to speak, right? With many new people in. Thank you.
India, we actually run a very asset-light model. Most of the land or buildings are held in Clint or through the private funds. So we have private funds for data centers, for logistics, and for the Clint. So that's how we use it to continue to invest. Will we use our balance sheet? Yes, we will, to do acquisitions of mispriced portfolio or capabilities. But to buy completed buildings, we are quite careful. How should I say? We prefer to build the buildings ourselves because it's complex. There are a lot of complex approval processes, and we have super high governance. All the approvals at the state level and the country level, we make sure everything is done so our portfolio is one that we know can clear all the regulatory hurdles. Yeah. In terms of whether you should invest in CLI or Clint, I think they offer different. Clint, I always get frustrated with where the Clint price is trading. It's a great portfolio. I look at the valuation of our assets in Clint versus some of the other assets held in the India REITs itself. Valuations are, in my view, quite modest, but it trades at a discount. But I think it partly explains maybe in terms of the depth and understanding of the India business opportunity. India market itself, the capital market is very big and very, very deep. So these are issues that, as a company, we are thinking about it as well. What do we do in the longer run? Yeah.
But our general response to that is you should invest in Clint and CLI and all our REITs. Thank you.
So we can tell who is the managing person and who is the salesperson here. All right. So thank you very much, friends, as well as shareholders for CLI for joining us today. I want to thank Chee, Koon as well as Paul for their illuminating articulation of the strategy, as well as providing some color to the questions. So we're always appreciative of management's candor. All right, so thank you very much for joining us today.